Hello and welcome to the Wendell Effect. My name is Brandon Wendell, Charter Market Technician, and this is Chart School. Welcome back to school. We're going to go ahead and examine some of the things that can hopefully help make you a better trader and or investor and give you some inside tips from the industry as well, and also hopefully have a little bit of fun. Before we get started, just to remind you, we are not broker-dealers or investment advisors. We're looking at this information from an educational standpoint, not telling you to buy, sell, or hold, or giving any personal recommendations on any securities. Really keep in mind that all trading does involve risk of loss. This is always a situation no matter what we do. We can try to limit the risk, but we can't ever eliminate it. And past performance is not indicative of future results. And we are not subject to trading restrictions, so we can have a position in a security and initiate one at any time. That being said, if you want to stay in touch with us, you can always email us at the Wendell Effect at tradingmindsetassociation.com. You can hit us up on Twitter. You can follow me at TraderBdub. You can also search for the Wendell Effect on YouTube. And follow us on our website, tradingmindsetassociation.com. So today we're going to talk a little bit about supply and demand zones. And the reason why is when we get into the market, we need to be objective and figure out a way where we can figure out where to buy and where to sell and consistently do it. So that way we have positive results. We want to have that consistent gains in the markets. And we do that by having a set of rules that we can follow that identify high probability opportunities. And really all we want to do is, copy the big institutions. Let's face it. You take a look at the Morgan Stanleys, the Goldman Sachs of the world, even Bank of America, the big traders out there, they have more access, more people, more knowledge, more money. You're never going to be able to do the same type of analysis and research as any of those particular securities or those companies, excuse me. So what we want to do instead is don't try to fight them, use them. If we can, the nice thing is those institutions are so large that they can be seen when they're buying and selling. So all we really need to do is figure out where they're buying and selling and copy them. The nice thing about this strategy is it's fractal. It can be used on any time frame and any security anywhere around the world. So, I've lived all over. I've lived in India, England, Singapore, and I've used these exact same techniques on those markets just as I do on the US markets. And like I said, they work pretty much on any time frame. So you can be a day trader or even scalper and use a lot of these techniques just as you would as a long-term investor. So that's pretty neat. Well, let's take a look at it. First, we have to understand there's two types of candles when we're looking at those. And that's usually what I use is candlestick charts. There are other styles of charting that are very, very good out there, but I predominantly use candlesticks. And we have what are called base candles, which really, they don't show much commitment to any kind of a trend. You're usually seeing sideways momentum with these. And then you have leg candles. Now, this is not the same as basing and legging inside of a zone, okay? This is just kind of classifying candles in general. So base and leg candles. Leg candles show that either bulls or bears were in control and prices moved in their particular direction. So a base candle in detail is simply a candle where the closing price is contained within the range of the previous candle. So basically it's either at or below the high and at or below the low of the previous candle. It's trading within the previous candle. So that includes the high and low, as I mentioned. So if the close of the current candle is at the high or low, it's still a basing candle. It's kind of like baseball. I say, tie goes to the runner. It is a base. Okay. So it's pretty simple. Like I said, if the wicks of a basing candle can stick out of the range, it's really just the closing price is the most important. So it's a base candle as long as the candle's close is within the range of the preceding candle. You didn't have enough momentum to close either higher or lower, so neither buyers or sellers are really dominating in that period. So when we look at this, you can see there's a close of a candle inside the high and low of the previous candle. So in some of these, you can see the wicks can stick out as long as the close is within the range of the previous candle from high to low, it is a basing candle. Even if it closes at the high or if it closes at the low, doesn't matter. That's a base. Now, a leg candle shows a bit of momentum in one direction or the other because you are closing either above the high of the previous candle or below the low of the previous candle. The wicks don't really matter. Again, it's the candle's close. So if you close outside the range of the preceding candle, it's a leg candle. So right there, you see we close below, close below, close below. Didn't matter what happened with the highs at all. Okay, they can either be within or outside, or close above. Again, doesn't matter what's happening on the other side, it's all about that close. So let me just pause here for a moment and go out to a chart. Here we are on the chart of the Dow. And looking at the Dow futures, we can actually look at every single candle and try to determine, is it a leg or a base? Actually, I'm going to use a horizontal line. There we go. And right now, this candle is still forming, but as of this moment, the close would be above the preceding candle, so this would be a leg candle, and it's going even further upwards. So it doesn't matter what happens to previous candles, just the one right before it. So this green candle, that is a base, because it's closing inside the range of the preceding candle. Previous candle here, that's a base, it's closing at the high of the preceding candle. So it's basing inside of that previous candle. That's a leg candle. This green candle is closing above the high of the preceding candle. That's a base. Again, just take a look at the close of the candle and see if it's touching any part of the preceding candle. Base. That red candle is a base. Base. Nope, leg. Okay, because you see it's above the previous candle's high. Base, leg. That's all it is. Pretty simple, right? So we'll keep an eye on that leg versus base candle. Now, the reason why we're trying to discern between base and leg candle is we're going to use those to help us identify supply and demand zones. So I mentioned in a previous video about order flow that institutional traders can't complete all of their large orders all at once. What they do is they break up their orders into smaller pieces, and we call that working the order. So what will happen is when they get some of their orders filled or a piece of it, they have to wait until prices return back to that price range that they've identified as a good buying area or good selling area before they can fill the remainder of their orders. Okay, we call that working the order. I know this for a fact because I actually used to work at a hedge fund and literally had to do this for my trading. And I've talked to other market makers and other big institutional traders that are friends of mine. They've disclosed that they actually do this as well. So when it comes to institutional order flow, sorry, the slide's a little messed up there. There we go. You can see right here, we got evidence of a large institutional buy order where they were trying to buy at this price. They might not have gotten all their orders filled, so the leftover buy orders kick in and cause prices to bounce once prices return to that area. So really what we're going to be doing is try to identify this type of pattern that tells us there's an institution buying or an institution selling, so when prices return to that area, we can take action as well. That's all it really is. So we have 4 different patterns. Here's one of the first. This is what's called a demand zone, and it's known as a drop base rally. Now, typically when you're looking for these, you're going to be looking from right to left on your charts. However, here we're going to go from left to right just for the formation purposes and just explaining it. So part number 1, and every formation will have 4 parts to it. Okay, part number 1 is the leg-in candle. The leg-in candle must be a leg, meaning it's got to close below the previous candle's low. If that wick had extended downwards below the close of this candle, this would no longer be a zone. Okay, so it's very specific in how to find these zones. That way we don't have any questions. We can make it more or less black and white and basically follow steady rules on how to find quality zones. So step 1 is you got to have a leg candle. Now, step 2, this is where it gets a little confusing sometimes. Step 2, you'll notice I highlighted in this shade area of yellow where the high and low of the leg-in candle is. And that's because a base or basing candles is not the same as a basing candle that we looked at before. Okay, a basing candle before was simply closing within the high or low of the previous candle. This, for the basing in a zone, any candles that close within the range of the leg-in candle are considered basing, whether they're legs or base, it doesn't matter. So right here, you see this red one closed inside the range of this candle. This green candle closed inside the range of the leg-in, but technically it's a leg candle, right? Because it closed above the previous candle. Doesn't matter. It's part of the basing. Even though it's a leg candle, it's part of the basing. And then the candle afterwards, this red candle also closed inside of this, and that's part of our basing. So we got 3 candles that are part of our basing, and that's typically where I'm going to draw my zone. I'm going to use the lowest low and the top of the bodies of the basing candles for my zone. And then after this basing, so we have our leg in, we have our basing candles that close inside the range of the leg in candle, then we have a leg out. Now the leg out has to do two things. The leg out has to close above the high of the leg in candle, otherwise it'd be part of the basing, obviously. And it's also got to qualify as a leg candle, meaning it's got to close above the high of the preceding candle. So it's got to close above both of those, the high of the preceding candle and the high of the leg in candle. Otherwise, it's not a leg candle. Now, I want to make sure we have a good imbalance when I'm looking for my zone. So the best would be that there's a sharp move even after the leg out. So you have the leg out candle, and the next two candles immediately following the leg out candle should each make new highs. Didn't have to close higher, as you can see with the red candle here, but it at least made new highs on each one of those two candles. So altogether, we have a leg in, okay, which is a leg candle, basing, which is any candles that close within the range of the leg in candle. We have a leg out that closes above the high of the preceding candle and the high of the leg in. And then we have two candles that follow through with brand new highs after that leg out candle. That's it. Now, the wicks of the basing candles can go below the leg in. That's not a problem. You just see I just use that. Also, the leg out candle, if it has a really long wick, you can still use that too. You just draw the line, whatever the low happens to be. So that is the first zone, demand zone, drop base rally. The next one is also a demand zone. The only variation is the leg in. This is a rally-based rally where you have a continuation of a pause in the trend or after a pause in trend. So here we have the leg in, once again, close above the high of the preceding candle. Any candles that close within the range of the leg in are part of the basing. 1, 2, 3, 4, 5. By the way, that brings up a key point. For a good basing, we should not have more than 6 candles. Doesn't matter the time frame. 6 candles is really the maximum number of candles I want to see for basing. If there's 7 or more, I usually will not use the zone. We spent too much time at the level and it will not have a lot of leftover orders. So continuing with our analysis here, we have basically the leg in is the only difference here. The basing is all there. The leg out candle must again close above the high of the preceding candle, and it must close above the high of the leg in candle, so it's a leg out. And you want to see 2 new candles immediately following that are making new highs. And we draw whatever the lowest low is in the formation. It could be the leg in candle, the basing candles, or even the leg out sometimes. Whatever the lowest low happens to be in the formation. That's your low line. And you place your stop losses below that low line. Our entry should be across the high, the tallest, or the top of the top, top of the highest body. That's where you draw the high line. That's usually where you start getting in or going long in this case. So that's really what we're looking for demand. We have 2 different types of demand, drop-based rally and rally-based rally. So going back to our chart here that I have of the Dow, if I'm looking on this 15-minute chart for an area of demand, I'm going to start off with what I call my guidelines, just a horizontal line. I'm going to put it at the current low. And I'm always going to look below that line and just continue to move it below the lows. So that way I do not cut through candles. I never want to do that. Okay, meaning I don't want to find a zone and then looking right, I went through a bunch of candles, so it disqualifies the zone. So all I'm doing is I'm looking left for a big rally. And I notice, well, there's actually a pretty decent move right here. And looking at that candle, that seems to be a leg candle. So I'll mark that off with a vertical line. Oops, wrong one. Got it right there. And now as I look back, I notice that's a base. Okay, I gotta find my leg in. Base, base, base. There's a leg in candle. Now that I have my leg in, I mark the high of the leg in. I mark the low of the leg in. There we are. And I see 1, 2, 3, 4 basing candles inside that leg in. Okay, so far so good. We got our leg in, 1, 2, 3, 4 basing. My leg out closes above the high of the preceding candle and above the high of the leg in. Oh no, we're missing the second new high. We only have 1 high after the leg in, so that's not going to be a good zone. Okay, no problem. We'll move on. So if it doesn't fit, you got to move on. So I keep going back, and again, notice I went to the low of this formation so I don't cut through candles. I don't want to mark this area off as a demand, something like this. because we've already been below that area. So we know it's not demand. Okay. So that's why I'm using this guideline to help me. So I'm looking back and I'm seeing, okay, there's a nice little pop here. But again, there's not going to be enough highs for a good demand zone here. So I'll keep looking left and down. I try to grab this. Go below all the lows, always. And I'm noticing right here as I'm coming into price, there's a nice rally right here. And new high, new high. Oh, this might be something. Okay. So we have a leg candle right there. It's closing above the preceding candle. I go to the next candle here, this green one, and I notice that's a base. It's closing inside that red candle's range. However, the red candle is a leg. It's clearing the previous candle's low. Okay, so that could be a leg in. I mark the low of the leg in. I mark the high of the leg in. And there's only one candle closing inside of that. And that's this one. So now I can mark off my zone. I'm going to use the bottom of the formation, which is actually the leg in candle, and I can use the top of the body of the basing candle. Now, one rule that I typically use is if there's only one candle for the basing, I go wick to wick. Let's give it a little extra. You don't have to, but I tend to find that if I don't do that, I'll miss out sometimes. So now I remove all my guidelines, and I've got a drop, base, rally, new high, new high. This says all the pieces for a demand zone. And it actually worked. We touched it once. We'll have to see if in the future we come back and use it again. That's how I find a demand zone. If I want to keep going for another zone, I'll mark off the low right here and continue looking back. We see here's another nice leg. Let's zoom in. So we have another possible leg right here. New high, new high. That's good. I look back and I see, well, that's a leg, but I'm noticing it's inside of this. If I go back to this candle, that is also a leg candle. And if I mark the high of that leg candle, the low of that leg candle, I have 1, 2, 3 basing candles before my leg out, new high, new high. So I'll mark the low of the formation, which is the leg in. Now I have more than one basing candle. I have 3, so I use the highest body in the basing and then remove my guidelines. And I have found a drop base rally demand zone. It's another one. So we happen to have a couple right in there. That's it. That's how you find demand. It takes some practice, obviously, but once you get practice in, it becomes pretty simple. You know, sometimes you don't even need all the guidelines. They just help as you're starting off to make sure you're finding good zones and not cutting through candles. So now that we've taken a little look at demand, let's go over to supply. With the supply zone, we have what's called a rally base drop. And once again, with our leg in, it's got to qualify as a leg candle. It's got to close above the high of the preceding candle, making it a leg up. Next, we're going to mark the high and low of that leg in candle. So just as before, the basing candles are all candles that close between the high and low of that leg in candle. Then we have the leg out. In this case, it's got to close below both the leg in candle's low and the low of the preceding candle. And it's got to do that because if it didn't close below the leg in, it'd be part of the basing. If it didn't close below the previous candle, it'd be a base candle, not a leg. So it's got to do both of those, close below the preceding and below the leg in. Of course, we want to see that imbalance, so now we need to see 2 new lows immediately following the leg out candle. So they don't have to close lower necessarily. It helps, for the imbalance, but it doesn't have to. The highest wick becomes your high line, the low of the bodies becomes your low line. Unless you only have one candle, then you can go wick to wick. And even if you have the leg out candle with the tall wick, you just use that. It's fine. So that is a rally base drop. So a variation of this would be the drop base drop for supply zone. Really the only difference is going to be the leg in candle. In this case, we have a drop. So we have a leg candle that closes below the preceding candle's low. Any candles that close within the basing, inside the range of the leg in candle are part of the basing. Then we have to have the leg out candle that closes both below the preceding candle's low and the low of the leg in candle. So it's actually part of the imbalance there and basically breaking to the downside. Then we have to have 2 new lows immediately following the leg out candle. Again, don't worry about the closes there. As long as it makes new lows, it shows that imbalance. And we're going to be using the high line on either the basing candles or the leg out candle, whichever is higher. Okay, if there's a wick that extends, you can use that. Right here, it talks about that in the third point. Or you go ahead and use the highest wick of the basing candles, and then we're going to use the bottom of the bodies of the basing candles or the low line. If there's only one candle for the basing, again, we can use wick to wick. So here we are back on our Dow chart, or the Dow futures chart, that is. I'm going to go ahead and put in a horizontal line at the current high for price. And the reason why is I can't see back to see where my supply zone is going to be. So I use that as a guideline, as I was saying. So I work my way back, and my supply has obviously got to be above those highs. And right here, I mark it above the high. That way I'm not using something that's already been tested or cutting through candles, as I said before. We did have a zone here. You can see that this one has already been used. We actually had, that's a base candle. Well, might as well go through the whole steps, but you can see that this was a leg candle here. I'm going to zoom in so we can see this one better. There we go. I guess it was okay. So we had a leg there. We have base. See the red candles closing inside the previous candle. We have base right here. And believe it or not, that's a leg. It's closing above the high of the preceding candle. So I take that as my leg in. We have a high and a low of the leg in. We got two basing candles. And it's like that's the high. There's the bottom of the bodies. Remove all the guidelines, and we have our zone. That was it. Rally, base, base, drop, new low, and it worked really, really well. So if you had seen that at the time and traded it, it worked extremely well for a move to the downside. It was the top of a pretty good move. So we're looking for a fresh zone, though. So I'm going to keep going back. And it looks like I don't have to go back too far. As you can see, we have a nice leg right here. Put in that vertical line. I have a base right behind it. Base right there. The red candle, though, that's a leg. As you can see, it closes below the previous candle's low. So I mark the low of that candle. I'll mark the high of that candle. And I only have these two basing candles. So we have drop, base, base, drop. And I go ahead and mark off the high of the basing candles, the bottom of the bodies, and remove my guidelines. And we are left with a nice zone that we can use going forward that has not been tested. So you have drop, base, base, drop, new low, new low. That's it. I want to keep going. I put in a horizontal line at the current highs, work my way back. Notice there's a zone, leg, base. Okay, so we have the leg candle, base candle, leg candle right there. And it's just the one candle. Again, mark the low, mark the high, go through all the steps. That's my leg in. I just have the one candle here as my basing. This one is actually not going to qualify. And here's the reason why. I'm missing one piece. If you're missing one piece, it's not a zone. The piece that I'm missing is after the leg out, I only have one new low, not two. Okay? So since that didn't qualify, I'm just going to remove it. And if I'm looking for the next zone, it's actually right here. I see, again, a leg candle, putting in a horizontal line here. It's a leg. We have the base as the green candle prior to it. Okay, it's closing inside. We have a leg candle there. So I mark the low and the high of the leg in. One basing candle, I can go wick to wick. And remove my guidelines. And the last thing I need to check, just like we did in the last one, make sure it's got two fresh lows following the leg out, and it does. That's a better zone. So that's how we find supply and demand zones using those four patterns. Now, not every zone is going to really be something we want to trade. So there are some additional qualifications that we can look at to make sure we're finding the best zones. And one of those is strength at the origin of the move. When you leave that zone, remember, we want to see a good imbalance between buying and selling pressure. So when you're finding a good demand zone, there shouldn't be any selling pressure anywhere nearby. So what I do is I look at the height of the zone between the two lines, the high line and the low line, and whatever that height is, extend it two times from the top of the line. There shouldn't be any red candles or big topping tails. Those big topping tails indicate selling pressure. So we shouldn't see anything showing selling pressure within 2 times the height of the zone as we leave the zone. If we do, think twice about taking the trade or maybe wait for some more confirmation. The same thing could be said for the supply zones. When you have the height of the zone measured times 2 extended away from the bottom of the zone, you should not see any buying pressure. So you look for, and there should be an absence of any green candles or bottom tails. So everything should be pretty bearish coming out of that area. If you have something, well, then it may not be as powerful of a zone. So let's go back to our chart. Here we are on our chart looking at these zones that I just formed, or not formed, but found. And even though zones may not be strong, they can still work. Keep that in mind. But we just need a little more caution when we're going to use them. Here's one zone that I found that was actually used. You can see there's times 1. And if I clone this, there's times 2. Now, within 2 times the height of the zone, you see we had some bottom tails coming in. So it shows a little bit of weakness. It did work, though, but that's not really what you want to see. Going a little higher, we see a better zone. We haven't used this one yet, though, so we'll see if it ends up working. But you have the height of the zone right there. And if we extend that downwards from the bottom of the zone, times 1, times 2, you can see we had nothing but selling pressure 2 times the height of the zone. The same technique would work for a demand zone. Let's see if I go back over here. Looking at my demand zones, same technique. We just go ahead and mark it off. Here's the low, the high. Here's times 1 on the high line, and times 2. This one is not the strongest of zones either, is it? Because you can see we didn't even go 2 times the height of the zone before we started falling back. So it may not be the best of zones. So that's one odds enhancement, if you will, that we can look at to find higher quality zones. There's another thing we can look for is breakouts. When you have a supply zone, that leg out, not just the leg out candle, but the entire move out before it gets a pullback, should break a prior low. If it does, it's a much stronger zone. Okay. Or right here, you can see we had drop base rally demand zone being formed. On that leg out or that move out, we actually broke a prior high that shows that this was very, very strong for that imbalance. So those are 2 things I look for as well when it comes to strength at the origin of the move. You can see on this particular move out, we had drop base rally. It didn't actually have 2 new highs for the follow through. And actually, when you have a breakout like that, you don't need the follow through. Okay, you don't necessarily need 2 new highs because we broke out of a prior high. It's kind of an exemption that I call it. Same thing if you have a move down. So here we had rally, base, drop. And if you break a prior low, even though you didn't have the 2 new lows, you only had 1 new low because you broke a prior low on the leg out, that allows you to take that as a valid supply zone. So that's something to keep in mind as you're looking at the trades. I know there's a lot of things to remember, but it becomes easier with practice, trust me. So again, we just simply need to find those areas of supply and demand so we have objective methods where to buy and where to sell. It's really all it comes down to. So we want to find those areas where the institutional traders were doing well and buying and selling, and where their leftover orders are likely to propel the markets once again in our favor. So if you got questions on this video, please let me know. You can go ahead and contact me, the Wendell Effect at tradingmindsetassociation.com. You can contact me on Twitter or follow me on Twitter at TraderBDub. And you can always search for the Wendell Effect on YouTube, as well as follow us on our website, tradingmindsetassociation.com. So I want to thank you for being here. Once again, my name is Brandon Wendell, Chartered Market Technician. Trade safe, trade well, and you take care until I see you next time.